When it comes to building wealth through index funds, two names dominate the conversation: VOO and VTI. If you're new to investing or trying to optimize your portfolio, you've probably wondered which one deserves your money. Today, we're breaking down exactly what makes these funds different, why that matters, and how to decide which one actually belongs in your portfolio. If you're serious about index investing and want to make smarter decisions with your money, subscribe to the channel so you don't miss future breakdowns like this one. Let's start with the basics. VOO is the Vanguard S&P 500 ETF. It tracks the 500 largest companies in the United States. Think of it as investing in America's biggest blue-chip corporations. When you buy VOO, you're getting exposure to companies like Apple, Microsoft, Amazon, Tesla, and Nvidia. These are the household names that most people recognize. The S&P 500 represents roughly 80% of the total U.S. stock market by market capitalization, which means it covers most of the value, but not everything. VTI, on the other hand, stands for Vanguard Total Stock Market ETF. It's the broader option. VTI tracks the entire U.S. stock market, including those 500 large-cap companies, but also mid-cap companies, small-cap companies, and even micro-cap companies. If VOO is a spotlight on America's largest corporations, VTI is a floodlight that illuminates the entire landscape of publicly traded American companies. VTI holds roughly 4,000 companies compared to VOO's 500. Here's where it gets interesting. Because VTI includes all those smaller companies that VOO doesn't, the two funds will perform differently depending on which part of the market is doing better. In years when large-cap stocks are winning, VOO will likely outperform VTI. In years when small and mid-cap stocks surge, VTI will pull ahead. This is important because market leadership rotates. Sometimes the giants dominate, sometimes the smaller players catch fire. Let's look at the numbers more closely. Over the past 10 years, VOO has had an average annual return of around 12%. VTI has been in that same ballpark, sometimes slightly lower, sometimes slightly higher, depending on the year. The difference is often less than 1% annually, which seems small until you factor in decades of compounding. But here's the thing. Past performance doesn't guarantee future results, and the gap between them changes all the time. The composition difference matters too. VOO is heavily concentrated in the technology sector, because the largest U.S. companies right now happen to be tech companies. Your top 10 holdings in VOO will be dominated by Apple, Microsoft, Nvidia, Amazon, and similar mega-cap tech firms. VTI is more diversified across sectors because it includes all those mid-size and smaller companies spread across healthcare, industrials, financials, consumer goods, and energy. If you believe tech will keep winning, VOO might feel like a purer bet. If you want broader diversification, VTI spreads your risk more evenly. Expense ratios are nearly identical, which shouldn't surprise you since both are Vanguard products designed with low costs in mind. VOO has an expense ratio of 0.03% and VTI is 0.04%. We're talking about the difference of $1 per $10,000 invested annually. This is not a meaningful differentiator between the two funds. Your decision won't come down to fees. Now let's talk about tax efficiency. Both funds are extremely tax efficient because they're index funds that don't trade constantly. However, VTI does trade slightly more often because it's rebalancing against a larger universe of stocks. This means VTI might generate marginally more taxable events in a taxable account, but the difference is genuinely negligible. In a retirement account like a 401k or an IRA, this doesn't matter at all, since those accounts are tax-deferred anyway. One argument in favor of VOO is simplicity and focus. If your goal is straightforward wealth building through exposure to America's most successful large companies, VOO delivers that with surgical precision. You know exactly what you're getting: the 500 largest firms. There's something psychologically satisfying about owning a piece of the companies that define the American economy. You can easily understand and track your holdings. The argument for VTI is completeness. Why own only 80% of the U.S. stock market when you can own it all? Small and mid-cap companies represent growth opportunities that VOO investors are missing. Historically, smaller companies have offered higher long-term returns, though with more volatility. VTI gives you that exposure without requiring you to research individual stocks or buy multiple funds. You get the entire market in one simple holding. Here's a question that might change your perspective. Do you want to bet that large-cap companies will keep dominating, or do you want exposure to the entire market, regardless of which segment leads? If you're truly agnostic about market segments and just want the whole pie, VTI makes philosophical sense. If you believe the large cap space represents the best risk-adjusted opportunities and don't need exposure to every publicly traded company, VOO is a solid choice. Many successful investors actually own both, which might seem redundant but actually makes sense from a diversification standpoint. Some people use VOO as their core holding and add VTI specifically to get extra exposure to small and mid-cap stocks beyond what's included in the S&P 500. This approach lets you customize your exposure. If you wanted, you could own 60% VOO and 40% VTI to get that blended approach. But for most people, the real answer is that you should pick one and stick with it. The difference in long-term outcomes between these two funds is minimal. What matters exponentially more is that you're consistent, that you invest regularly, and that you don't panic sell during downturns. Investors who pick the theoretically perfect fund but abandon it during a bear market will underperform investors who picked the slightly suboptimal fund and stayed disciplined. If you appreciate these kinds of nuanced financial comparisons that actually help you make better decisions, please like this video. It helps us continue creating this content for people who want to understand their investments rather than just follow the crowd. Let's talk about real-world scenarios. If you're just starting to invest and want simplicity, I'd lean toward VOO. It's a smaller fund with lower complexity. You can explain your portfolio to a friend in one sentence. I own the 500 largest American companies. If you're an experienced investor or someone who values completeness and wants exposure to the entire market spectrum, VTI is the better philosophical fit. Consider your time horizon too. If you're investing money you won't touch for 20 or 30 years, the choice between VOO and VTI matters even less. The long-term wealth you build will dwarf any minor performance differences between them. If you're investing with a 10-year horizon and trying to optimize, the nuances become slightly more meaningful, though still not dramatic. Your income and savings rate also matter. If you're a high earner saving aggressively, having slightly better diversification with VTI might appeal to you because you're building a larger position and want that risk spread across more companies. If you're saving smaller amounts and keeping it simple, VOO's focus might be preferable. There's also the question of your other holdings. If you already own other investments that give you mid-cap and small-cap exposure through other funds or individual stocks, then VOO makes sense as your core large-cap holding. If VOO will be your only stock market investment, VTI becomes more attractive because it ensures you're not leaving out entire market segments. Let's also address a common misconception. Some people think VTI is riskier because it includes smaller companies. Technically, small-cap stocks are more volatile individually, but because VTI holds thousands of them, the overall fund is quite stable. You're not buying a few risky small-cap stocks, you're buying thousands of them, which smooths out the volatility through diversification. So VTI isn't significantly riskier than VOO in practice. Another myth is that VOO is somehow a better fund because it's more popular and holds bigger, safer companies. Popularity doesn't make a fund better, and large-cap companies aren't necessarily safer long-term investments than a diversified portfolio of all-cap companies. Size doesn't guarantee returns. Some of today's smaller companies will become tomorrow's megacaps. The emotional element shouldn't be ignored either. If you own VOO and see Nvidia or Apple have a fantastic year, you feel great about your choice. If you own VTI and see Nvidia surge, you benefit, but the impact on your overall fund is more diluted because your position is smaller relative to the whole portfolio. Which psychology serves you better depends on your personality. Some people like concentrated upside. Others prefer steadier, less volatile returns. Let's consider dollar cost averaging, which is how most people actually invest. You're not dropping $50,000 in one day. You're investing $500 every month or $2,000 every quarter. Over time, with consistent contributions, the difference between VOO and VTI becomes genuinely trivial. You're building wealth systematically, and both vehicles will get you there just fine. Tax loss harvesting is something to consider if you're in a taxable account. Because VOO and VTI track different indexes, they can temporarily diverge in value. If you wanted to optimize for tax efficiency, you could sell the one that's down to realize a loss and buy the other, then switch back later, capturing the tax benefit while maintaining nearly identical market exposure. This is an advanced tactic that most people won't use, but it's another reason some investors hold both. What if you're investing through a retirement account? In that case, The differences between VOO and VTI are even more negligible. Your 401k or Roth IRA isn't paying capital gains taxes, so tax efficiency doesn't matter. You're not going to be doing any harvesting. You should just pick the one you understand better or feel more comfortable holding for decades. Let's talk about what could change this decision in the future. If the U.S. stock market composition shifts dramatically and small-cap companies start driving overall returns much more than large-cap companies, VTI would have a stronger case. If technology stocks become a smaller portion of the market and diversification becomes less about holding tech giants, VOO might look less appealing. But these shifts happen over years and decades, not months. Here's my honest take after looking at all of this. For most people, VOO is the better choice for simplicity and focus. It's straightforward, it's widely understood, and it gives you clean exposure to America's largest and most successful companies. But if you value owning the entire market and don't mind slightly more complexity, VTI is equally valid and arguably more philosophically sound.